What happens when you're in control of your finances, your career, and your well-being? There's no limit to what you can achieve. I'm your host, JaeVic, bringing you on a journey through Finance Fitness and Finesse, a podcast about developing your 8 dimensions of wellness. If you're looking to elevate your wealth, well-being, and discover the power of balance, join me bi-weekly, Mondays and Fridays, to learn why money matters, but wellness counts. Hey finessers! Welcome back to another episode of Finance, Fitness, and Finesse. It's More Money Monday, where we break down confusing financial jargon, stigmas, and assumptions as we dive into small steps you can make to take control of your financial wellness. I'm your host, JaeVic, and today we're going into a topic that impacts all of us, whether we realize it or not: inflation. We'll break down what it means, why it happens, and how it affects our everyday life. We're also going to talk about a topic you may not have heard before: money dysmorphia. Let's get into it. Alright, so what exactly is inflation? In simplest terms, inflation is when prices go up and the purchasing power of your money goes down. Think back to when you used to buy snacks as a kid. You should notice that your dollar does not stretch as far as it used to, especially in recent years after the pandemic. That's inflation at work. Right now, the inflation rate is at 3.3% as of May 2024. 3.3% doesn't sound like much, but when you put it into perspective that between January 2020 and May 2024, consumer prices shot up by 21.75%, and we all know the ridiculous cost of housing right now. Inflation has caused a cost of living and housing instability crisis for many, but especially young adults. Currently, 31% of Gen Z are living with their parents because they can't afford to buy or rent their own space. And even those who have moved out still need help from their families to make ends meet. I need to say this to all my fellow young adults out there. If you're feeling pressured by societal milestones, remember and remind yourself of this: you're on your own path. You are the dictator of your own life. Not your boss, not your parents, not your partner's parents, and especially judgmental outsiders. Growth comes from our mistakes, and that means weathering the storm of this inflation nation that we live in. Inflation impacts us every day. We can see this in the price of goods we try to buy. I know I'm not the only one noticing the cost of living rising while our paychecks don't keep pace. Finding that balance between income, expenses, and saving or investing is becoming harder every day. But we need to find ways to protect the longevity of our money. Otherwise, we risk slipping into that cost of living crisis that we're already living in, but let's just try to prevent it from lasting over our lifetime, right? Visualize this with me. Imagine you have $100 for your weekly groceries. If inflation is high, that same $100 buys you less than it did before. Now you're forced to either cut back on what you buy or find ways to stretch your dollar further. It's a tough situation, especially for those with fixed incomes or limited financial flexibility. I'm talking to all those students out there just like me. We can either figure out how to finesse and continue to work for money on top of our school workload, or we can just keep taking out loans, which we all love doing that, right? But why does inflation happen? There are a variety of causes and different types, but 2 you should know are demand-pull inflation and cost-push inflation. Demand-pull inflation happens when the demand for goods and services exceeds the available supply. I know we all had that supply and demand course when we were like 13 in that economics class that was snooze town because they didn't really tell us how the information could be applicable to our lives, not only as 13-year-olds, but later on as adults. Which you guys are tuning in to podcasts and information like this because your back is against the wall, and now you know that you have to understand this stuff and figure it out yourself. So, I'm happy you're here, but let's listen up about how supply and demand impacts inflation. Demand-pull inflation happens when the demand for goods and services exceeds the available supply. This happens due to several factors, such as increased disposable income, lower interest rates, or more money circulating in the economy. But how do these factors come into play, and who the heck influences them? When consumers have more disposable income, the trend is to spend more on goods and services. When you have more money, who wouldn't want to spend it, right? This increase in demand can outweigh supply, causing prices to rise. Increases in disposable income can also happen from government policies like tax cuts, rebates, or direct stimulus payments. For example, during economic downturns, the government issues stimulus checks to individuals, families, unemployed, and others to boost consumer spending and stimulate the economy. In case I lost you on all that financial talk and mumbo-jumbo, understand that a stimulus check is a direct payment from the government to individuals or families to boost the economy during times of economic hardship. Another influence are changes to minimum wage laws or strong labor market conditions that produce higher wages and then more disposable income for workers. So what happens when interest rates drop? Well, it becomes cheaper to borrow money, which encourages both consumers and businesses to take out loans and spend more. The Federal Reserve, which is the central bank in the United States, is responsible for setting these key interest rates. When the Fed, I'm sure you've all heard that, when the Fed decides to lower rates, it makes borrowing less costly for banks. This reduction then trickles down to consumers and businesses, making loans for things like homes, cars, and business investments more affordable. But let's flip the script for a moment. When the Fed raises interest rates like it has been, borrowing money becomes more expensive. This is an effort to slow down consumer spending. But there is a little bit of a silver lining for savers. Higher interest rates mean better returns on savings accounts and bonds. So while it's more costly to borrow when interest rates are high, those who lend or save money can benefit from higher returns. It's a balancing act where the Fed adjusts rates to either cool down an overheated economy or to encourage spending and investment during slower economic times. I think of it as what goes up must come down. Think about it for a second. Right now, the interest rates on getting a mortgage are super high, but the interest rates that are in your favor, like on high-yield savings accounts, are also pretty high. Hopefully soon, when the inflation rate starts to take a turn in the opposite direction, you're going to see those interest rates on loans go down. But then if you don't have a fixed interest rate with your high-yield savings account, that rate might also go down. Now, it'll still stay a high-yield savings account. It'll be better than your brick-and-mortar bank, but it may not be that 5.5%. It may go down to like 3.5%. It really depends on the bank and where the inflation rate is at. Okay, so just to reiterate who is impacting inflation, central banks manage interest rates and control the money supply. Through monetary means money. Through monetary policy, the Fed can influence borrowing costs, liquidity, and overall economic activity. Government actions such as passing tax laws, policies, or approving stimulus packages also influences the rate of inflation. There are a ton of other factors I won't bore you with for now, but the gist, if you haven't gotten it yet, is that Uncle Sam has a lot of departments that have an impact on the value of your money. Cost push inflation happens when the cost of raw materials, wages, or manufacturing goes up without an increase in demand for the final product. Think about it this way. If the price of oil suddenly shoots up, everything that relies on transportation or manufacturing gets more expensive. Or if the companies have to pay their workers more, they might raise prices to cover those higher wages. The sweet smell of our money burning with our gasoline. The entities who can influence cost push inflation include industries and companies that control the supply of essential materials like oils or metals. Labor unions also impact it when they push for higher wages for workers. I think everybody should get paid what they want, but just saying what impacts it. And let's not forget the government. Taxes, also called tariffs, on imports can spike production costs, which businesses often pass on to who? Us, the consumers. So whether it's pricier materials, higher wages, or increased manufacturing costs, the outcome is the same. Prices rise, and our money doesn't naturally keep up. Cost push inflation can be extra annoying because it's not even really driven by consumer demand. This makes it harder to manage through standard monetary policies. Again, financial lingo here. Monetary policy refers to actions by a central bank to manage the supply of money and interest rates. This is to achieve economic goals like stable prices and maximum employment. Alright, stay with me on this part because we need to be aware of all sides of inflation. Get woke so you don't stay broke. I digress. But did you know that a little bit of inflation can be beneficial? An optimal inflation rate of around 2% per year encourages spending rather than saving, which tends to boost the economy. It also helps erode the value of debt, making it easier for consumers to pay off loans or mortgages. Our wonderful Fed is working real hard, of course, to keep inflation in check to avoid negative impacts like a recession. Hopefully. Okay, we're almost done, but how is inflation measured? More terms you should know. The Consumer Price Index, or CPI, is a common method. The Bureau of Labor Statistics has been reporting the CPI since about 1919, sampling about 94,000 products and services each month. They track changes in prices and update the quote-unquote shopping cart of goods to match current buying trends. This gives us a comprehensive picture of how prices are moving over time and helps us understand the overall rate of inflation. Another key way to look at inflation that I've used is through the lens of personal finance, obviously. If the interest rate on your savings account is less than the inflation rate, your money is actually losing value over time. I'm talking, look at your APY. It probably says something between 0.01 or 0.05%. Congratulations on the 5 pennies you earn each year. But how does that compare to 3.3% of inflation? On to money protection strategies. You should already know about high-yield savings accounts from listening to episode 1, but you can also start by keeping an eye on your spending and shopping around for the best deals. Avoid keeping too much cash in just a savings account with a low interest rate. Instead, consider investing in the stock market or tangible assets like a property, if you can afford it. I know I can't right now, and I'm not trying to take out a huge loan, but for those on a limited income, such as students like me, utilizing a high-yield savings account is a safe, low-risk way to combat inflation compared to your average bank sucking the life out of your money. I know I keep going back to HYSAs, but it was my first really great investment, so I can only really advocate for that. Diversifying your investment portfolio helps shield you from the worst effects of inflation over time. If you are interested in investing in stocks, ETFs, etc., I would start with asking a trusted person in your life, or a banker, or a finance professional. I'll have future episodes to simplify the stock market jargon in Season 2, but for now, back to the basics. Let's touch on a lesser known but equally important topic called money dysmorphia. I'm sure you guys have heard of body dysmorphia. It's kind of the same thing, but just put money in place of your body. Money dysmorphia refers to a distorted perception of one's financial situation. This can lead to symptoms such as excessive worry about money, frequent monitoring of bank accounts, or avoiding financial decisions entirely. For example, you might think you're struggling financially when you're actually doing fine, or you might believe you're in great shape when your finances are actually a mess. You know, thinking you're woke when you're actually broke. Money dysmorphia is not officially classified in the DSM-5, that's what psychologists or therapists use to diagnose people, but it can still seriously impact your mental and emotional well-being. Money dysmorphia is primarily caused by comparing yourself to others, which we all know happens daily with the exposure to social media, but it can also be triggered from money trauma that we experience throughout our life. Money dysmorphia traps us in a cycle of stress and missed opportunities due to avoidance. Some people may feel like they can't escape from the worry or being consumed by the incessant fear of their financial status. This obsession disrupts daily life and clouds our ability to focus on anything beyond perceived monetary struggles. Avoiding financial decisions only deepens our sense of instability and inability to understand. Over time, this takes down our self-esteem and leaves us trapped in a relentless battle with our money. Well, we all know it starts with self-awareness. And then from there, you can think about collaborating with mental health professionals and financial counselors as support. Financial psychology is a growing field I'm very passionate about because it bridges the gap between financial management and well-being or mental health. By acknowledging your financial past, you can start to make peace with your money and understand your financial habits and triggers. Before healing begins, you need to accept that there's a problem. If you find yourself struggling with money dysmorphia, you can check the sources in the show notes or email me if you want help finding a financial therapist. Start reflecting on your wants versus your needs. And also, give yourself credit for investing your financial knowledge in podcasts like Finance Fitness Finesse. Keep building that confidence and understanding, and I'm confident things will start coming together in your favor as you apply what you've learned to your life. That's all for More Money Monday. Remember, understanding inflation and managing its impact on your finances can help you protect your money in unstable economic times. And if you're like the rest of us struggling with financial stress, don't hesitate to seek help. That's where you can be different from the majority. Remember, time is your biggest asset. Don't let it depreciate in value. Thanks for tuning in to today's episode of Finance, Fitness, and Finesse. If you found this episode helpful, share it with a friend so they can understand this inflation nation and how to fight it. Please help me learn with you, and don't forget to subscribe, follow me, and leave a review. I'll see you guys on Fitness Finesse Fridays. And if you don't know, now you know. Disclaimer: this podcast is for informational purposes only and does not constitute financial or mental health advice. Always seek professional guidance tailored to your personal needs.